You've seen the headlines, right? Some brand new crypto project raises millions of dollars in minutes. How in the world does that happen? Well, it's not the bank, and it's definitely not magic. Today, we're going to crack open the entire crypto fundraising playbook. It really is the question that baffles people on the outside and gets insiders so excited. I mean, traditional startups, they spend months, sometimes years, chasing investors. Crypto projects, they can pull it off in a few hours. The secret really comes down to three super powerful and very different ways of raising money that just skip the old system entirely. So, to make this all make sense, let's use a few simple analogies, okay? First, imagine a crypto Kickstarter where you're backing an idea directly from the creators. Then picture a Wild West pop-up market. It's fast, it's open to everyone, but it is incredibly risky. And finally, think of it like a curated app store where a big trusted name checks everything out before you're allowed to buy. But wait a minute, why go through all this trouble in the first place? Why not just, walk into a bank or pitch a venture capitalist? The answer to that question gets to the very heart of what crypto is all about. Look, sure, they need money for developers and marketing, of course, but a token sale is about so much more than just cash. It's about creating a global community of users from day one who are literally invested in the project's success. It's about generating a massive amount of buzz, and maybe most importantly, it's about completely sidestepping the traditional financial gatekeepers. So let's meet the three main players in this game. You've probably seen these acronyms flying around: ICO, IDO, and IEO. They all stand for initial offering, but believe me, where and how that offering happens changes absolutely everything. First up, we've got the ICO, the initial coin offering. This is our Kickstarter model. A team puts out a big plan, they call it a white paper, write on their own website, and asks for money directly from you. It's the original method, but wow, it is also by far the most dangerous. With no one in the middle, the potential for scams is just massive. Next is the IDO, or initial DEX offering. This is our pop-up market. Here, the sale happens on a decentralized exchange. Think something like Uniswap. It's basically a trading platform run by code, not a company. The huge difference here, trading starts instantly. That means you get instant liquidity, but it also means you can get instant, gut-wrenching price swings and the ever-present threat of a rug pull, where the developers just take the money and vanish. And that brings us to the IEO, the initial exchange offering. This is our curated op store. A major exchange, like a Binance, acts as the gatekeeper. They're putting their own reputation on the line by vetting the project before they offer it to their users. It is a much, much safer path. But, and this is a big but, safer doesn't mean risk-free. The exchange has all the control, and even their hand-picked projects can still end up failing. Okay, this slide right here, this is your cheat sheet. You can see the trade-off clear as day. ICOs give the project team total control, but offer you, the investor, basically zero protection. IEOs, on the other hand, give you the most protection, but all the power and all your trust is in the hands of that big exchange. And IDOs, well, they're the chaotic, high-speed, high-risk middle ground. All right, with all this talk about risk and crazy volatility, it is absolutely critical that you know how to spot the danger signs. The crypto world is filled with amazing innovation, but it also attracts a lot of predators. And the first term you just have to know is the rug pull. It's exactly as brutal as it sounds. A team raises a fortune from a bunch of excited investors, and then poof, they're gone. The website disappears, the social media accounts get deleted, and the money is gone forever. This is the ultimate nightmare scenario, especially in the wild worlds of ICOs and IDOs. So what is the number one biggest red flag you can look for? Simple. Any project that promises guaranteed profits or can't miss returns. Let's be crystal clear. No legitimate investment in any market on planet Earth can guarantee you a profit. Scammers use this language to play on your greed and that fear of missing out. And the second giant warning sign? An anonymous team. Come on, think about it. If the people behind a multi-million-dollar project won't even show their faces or link to real professional profiles or prove who they are, why in the world would you trust them with your money? Transparency isn't a bonus here. It is the absolute bare minimum. Okay, we've talked about all the risks. Now let's get practical. Let's walk through a simple checklist you can use to protect yourself before you even think about putting any money on the line. Don't just take their word for it, you gotta dig in yourself. First, verify the team. Are they real people with a real track record?
Second, you have to actually read the white paper. Does the idea make any sense, or is it just a bunch of fancy buzzwords? Third, look for security audits from trusted firms. Fourth, and this is a big one, ignore the hype. Scammers create a sense of urgency on purpose. And finally, the golden rule of all investing: start small. Never, ever invest more than you are truly prepared to lose completely. So, after all this, which method is the best one? You know what? That's the wrong question. There is no single best way. From the wild frontier of an ICO to the walled garden of an IEO, each one is just a different point on the risk-reward spectrum. The real question, the one you have to ask yourself, is this: which level of risk are you actually willing to accept? Answering that question honestly is the first and most important step to investing wisely in this space.